All right. I have the distinguished pleasure of being able to share with you our next session with Dr. Jackie Meyer. Jackie, introed me. It's such an amazing thing to meet another entrepreneur that has a vision that's so big, but achievable too. Jackie set out to change this industry and really help people create the life that they want, reach their true potential, and you know, reach levels with their clients they've never been able to before. It was one of the things that really drew me to her and working with her in the first place. And the team that she had built and that we've continued to build, at TaxPlanIQ. So it's an honor to work with her and them every single day. So just if you don't know much about Jackie, 40 under 40 honoree with CPA practice advisor from 2018 to 2022. She's a pioneer in tax planning advisory, serial entrepreneur. She's a speaker. She speaks to tens of thousands of financial professionals and taxpayers annually, focusing on the practical solutions that enhance tax and financial literacy, recruitment, retention, leveraging AI to accounting firms. She is a Swiss Army knife of it all. But after building her award-winning CPA firm, as you guys have heard, she founded TaxPlanIQ, and she's literally changed the industry with the ROI method of value pricing, which is what she is going to go in depth with you here in just a few seconds. So her mission, again, is to improve the health, wealth, and relationships for all in this space. So Jackie, it's an honor to have you, and the floor is yours.
Thank you so much, Dave. Hello, everybody. All right, let's wake up. Let me see some emotions out there, some reactions. How are you feeling? All right, yes, laughing is always a good one. Okay, let me hop over to my slides. There we go. I have to say, this is the first time that I am deep diving in depth to show you every detail of this ROI method. And I am more nervous than probably the biggest presentation I ever gave, which was for 10,000 people on a webinar for TCJA, which is a pretty complex topic, right? I just want it to go perfect. So as we dive in here today, we'll see how far we get through this. There's a lot of exciting stuff to discuss. Please continue to pop in feedback, questions, comments. I want to make sure that you understand everything we're talking about and that you feel really equipped to run with this value pricing method, because it is the first ever pricing method that's truly measurable, allowing you to value price upfront for your clientele for any advisory service. And tax advisory is the easiest thing to value price out of any service whatsoever. And through value pricing and tax advisory, I saved my firm, I saved my family, my life. I was suffering from so much. I was diagnosed with chronic fatigue at one point, which I still have and I maintain. But this is so important to me to share with you to hopefully make your lives that much better. So let's dive in. All right. Now, I am the type to want to just spill the beans right up front, but because it's the middle of the afternoon and you're probably getting tired because we've had a long day, I'm saving some very big news until the end of this session. Well, as far into the session as I possibly can. It is huge news for this profession, so please stick around for that. Can't wait to tell you. Let's talk a little bit about the problems we have. Hourly billing is broken. And we've all been there. You're working more hours, you're underpaid for the expertise that you spent years acquiring, and yet you cannot scale your firm without burning out. And guess what? Your clients don't like it either. They want results. They don't care about how many hours are involved, and they sure don't want a surprise that it took you 20 hours instead of 10. Those are some of the hardest conversations you can ever have. So the hourly billing model, and dare I say, even fixed fee models to a certain extent, are broken. There's only so many hours you can work. you're not rewarded for your knowledge and what you bring to the table and investing in yourself. That's a big topic for today, a big theme, investing in yourself. And value pricing allows all of those things. And so I would even go as far as to say that it solves pretty much every problem we have in this profession. And if you don't believe me, pop in the Q&A or chat, and at the end, I'll go through them and tell you what's the problem you think you have that I can't solve, and I bet you this solves it. I'm that confident. All right, so we know that tax advisory increases profit margins. We know that it reduces your working hours. It helps you pay your team better and recruit better, and it delivers way more value to your clients. And Dave dove into my story earlier. It's so nice to have someone else tell the story. It actually becomes more emotional now when other people say it versus me. But I had a very traditional practice. I was offering full services at my accounting firm, and I was working 40 to 60-hour weeks. And that was all fine and dandy until I, started having kids, right? So those little boogers, they take up a lot of your time. And so I was working the middle of the night, weekends again, just like back at Deloitte in the day. And I would literally look like this skeleton. I just took this picture on the right the other day. This is my living room. You'll see my 7-year-old son's handwriting paperwork there. And that's my new kitty cat. That's Bethany. But I joked the other day to my team that this was me before creating the ROI method of value pricing, because it has been such a game changer for me. All right, let me check in real fast, make sure everyone's doing okay. Yep. Okay, awesome. I see one person's having a little trouble with the screen, but hopefully you can get that figured out. All righty. So yeah, I don't really need to say a whole lot more other than the fact that I can empathize with any burnout, mental health problems, physical health problems that you may be going through or you might go through in the future if something doesn't change with your firm. We really want to help people. But we're numbers people, right? And so helping people to us is just putting our head down and working hard, and harder and harder and harder. And at the end of the day, your health tends to sacrifice for that. And so we're going to get away from that. I 3 to 5 times my revenue by converting clients one by one to tax advisory service. And I created this ROI method of value pricing after becoming member of the year at another tax planning group. I attended tons of seminars. I did pretty much all the coaching out there that you could do. And I thought something's still missing here. I still don't understand how to value price. Anyone understand that? Anyone with me there? Like, that's a great theory, but how do you really do it? How do you measure it? And that's what I'm going to show y'all today. Okay. So we all know what happened. I am selling my firm with 56 clients for a cool 7 figures. So that was awesome. And I went on to be able to do a bunch of coaching and develop TaxPlanIQ and become a serial entrepreneur, which was awesome. And the why behind this method is really like the complete ambiguity that we're left in with these keynote speakers out there that are telling us value price, but not giving us any practicalities around it. There's no standards. And so today you will see a consistent, proven process. It is more ethical than hourly billing. It is not a contingent fee. We'll talk about that. And it is really win-win-win. Your clients will be paying you probably 3 to 5 times more, but they'll be that much happier with the results because you are going the extra mile to do what you need to do to be that trusted advisor. So a little history of pricing in our profession. I put together this little graph. So in the 1920s or so, attorneys decided to charge by the hour, and accountants decided that seems like a good idea because I don't know how else to price, so we'll copy that. And that is why hourly billing has become the most traditional approach for many, many decades. Now, in the 1980s, actually 1989 is when Ron Baker implemented value pricing in his firm. People started realizing, yes, 1980s, that's a long time ago, y'all, that people have been advocating for value pricing and we're still not doing it. We realized we need more guidance here. There's a recognized need for a change in pricing methodology. And so in my own CPA firm at Meyer Tax, after doing all this coaching and other tax certifications and training as a CPA firm, I came up with a calculator, the ROI Method of Value Pricing Calculator. And what it does is it just provides, you set your parameters. You say, okay, I want to bring at least a 200% return on investment, tangible return on investment to my client. And then you adjust that fee as part of the savings by what's called CURB, complexity, urgency, risk, and the intangible benefits you bring to the table. And then we incorporated that pricing calculator in TaxPlanIQ when I created it at the end of 2020. And today I am previewing, oh gosh, I can't tell you yet, but previewing something that one of our largest governing organizations for CPAs will be mass releasing next month. Do you realize how big of a deal that is? They are supporting this method. They are releasing it to their members. And they are clarifying all the jargon about, no, this is not a contingent fee. Yes, you can do this. It's okay. And it's better for your clients. Pretty cool stuff. All right. So the parameters around the ROI method, we're really just honing in on value, tangible financial gains, which for a tax advisor is tax savings. We're looking at a weighted average calculation from those financial gains. So let's say your financial gains are $100,000 in tax savings you've identified for the client. You want to make sure you bring at least a 200% ROI. So you know your fee starts around 50K, but is it really complex? Is it urgent? Is it risky? And are there a ton of intangible benefits? Yes. Then I would stick to that 50K. If not, I would actually lower the price to get a bigger ROI. So that could be a threshold of 800% ROI for you at your firm. You decide that. In TaxPlanIQ, our threshold is between 200 to 400% ROI. And we'll actually be changing that because I put hundreds of hours into this workbook I'll be showing you today. We'll be expanding on the calculator in TaxPlanIQ to give you more customization around how you want to do your pricing. So here's the steps again. 1, identify financial gains, the tangible benefits you bring to the table. 2, determine your ROI threshold. What's the minimum you want to bring to the table for your clients? At Meyer Tax, we would not accept a client that I couldn't find an estimated 200% return on investment immediately. We literally would just turn them away. Now, I know a lot of users that work with startup companies. They like to bring 100% ROI to the table. That ROI does tend to continue on for many, many years for a lot of strategies. And so there's 2 different components to it that we'll look at today. We want to understand our CURB factors. That's the best acronym I could come up with for the complexity, urgency, risk, and intangible benefits. So we'll talk about that. Of course, higher CURB is going to be a lower ROI for the client. Lower CURB, lower complexity, et cetera, is going to be a higher ROI to the client. And medium is, right there in the middle. So whether it's like high is 200%, medium's 300% ROI, and low is 400%. We'll take a look at the workbook and figure that out. So these are those CURB factors. Let me check in my chat, make sure everybody's good. Moral dilemma. Yes, we will talk about that. No worries. All right, let's get on to it then. Is value pricing ethical? So as I said, let me clarify, a contingent fee is charged on the back end or adjusted for final tax savings you find on a return. The ROI method of value pricing is not adjusted for final results. It is charged upfront based on that perceived financial value. Yes, the tangible financial gains you're estimating, you're never guaranteeing those, and your other factors that no one thinks about. Because complexity, urgency, risk, and intangible benefits are all very important and very valuable as well, right? The AICPA encourages value pricing. In fact, one of the things I used to create my ROI method calculator was this pricing tool that I pulled from their member website. So it literally says, here's how you value price. Take results, take benefits, take output, take skill of personnel, take risk of services. That's all incorporated into my weighted average method. Also, the well, I'll circle back to that in a little bit. So let me give you a couple of testimonials. This is Matt, who is on our advisory council for TaxPlanIQ. He is a wonderful fella. He was also a coaching student. And he says that he's used value-based pricing for years, but determining the right price was always a challenge. They constantly wrestled with finding a balance between exceptional value and ensuring we're fairly compensated for our expertise. After being introduced to the ROI pricing method by Dr. Jackie Meyer, everything changed. The process of setting prices became much more straightforward and transparent. It allowed us to align our fees more accurately with tangible results, and it also gave our team the confidence to communicate and sell our services at their full value. Awesome. Here's another testimonial. The ROI method of value pricing just makes sense. It's made it so much easier to price clients in a fair and uniform way, cutting through the vagueness that often comes with traditional value pricing. I haven't come across any other methods that offer this level of clarity and practicality. There aren't any. This is the only calculator that exists. Honestly, I feel like most accountants providing tax strategies are massively undervaluing their services, and it's because they don't know how to show their value through an ROI. I highly recommend the ROI method to others in the field. It reflects the value we truly deliver. Kendall. One random case study of one of our first growth plan users. Their very first tax plan they sold was for $70K. I gotta admit, y'all, I never sold a tax plan for $70K. My parameter kind of capped out around $50K is the highest fee that we ever charge for tax planning. It depends on what services you're offering, right? Like I didn't do captives. I didn't actually do a ton of super advanced stuff. I just worked with high net wealth and I was able to find a tremendous ROI for that with entity selection, FLPs, stuff like that. And they saved the client over $1 million. So they were very, very happy. Another case study is my own. I have the very first client, an existing client of Meyer Tax named Pete, that I converted to this method. And I love what Daniel said about exporting your list of clients from like top revenue down. I was not picking my top revenue client. I was picking one of my happiest clients, one of my biggest supporters, biggest fans. Because when he came to me in 2012, he had done his own 1040 with like 20K ones and accidentally reported capital gains as royalty income. I amended his return, instantly saved him 150K. Of course, I only charged hourly for that. I should have charged way more than 1,500 bucks or whatever it was. But I went back to him in 2016 when I decided to completely transform my firm, lead with tax advisory, and never look back. Said, hey, can you be my guinea pig on this? I'm going to be totally honest with you. You're the first person I'm pitching this to. I'm nervous about it, but I think that I can bring, a 250% ROI to the table or something like that. It was actually 200% immediate ROI, and then 378% over 10 years. This was the actual ROI report that I produced for him in Excel. Okay. And what ended up happening, as you can kind of see on the left, is I ended up saving him an 1,158% ROI. But here's what's cool is we were both really happy because I took his fees from like $4,000 a year for probably the most complex 1040 that I prepped to $15K per year. So what does that come out to? 4, 8, 12, about 400% more. And netting him that 81K in his pocket and that 1158 ROI. And as Dave mentioned earlier, we tend to underestimate the ROI and we tend to bring even more to the table. And so that's how we've designed TaxPlanIQ, is so that you can really shock out, wow, and awe people with those results. All righty, let's see. Just checking my notes here. Time to announce the big news. Da, da, da. So this is not public yet, although one person accidentally posted it on LinkedIn. That's okay. I got great response. The AICPA is mass releasing this methodology to their members. And I have proof of the pudding where they state that value pricing is not a contingent fee and that it's completely ethical. Okay. That's me. TaxPlanIQ was in the AICPA Accelerator Program in 2023. That's me visiting their Thought Leadership Summit in New York. And I got a joke, you know, on the left here, the AICPA, some days I'm just on fire. That's them over there, right? They're just thinking, ooh, go me, right? Finally modernizing this profession. So the big announcement for this release to CPAs is going to be on November 20th. April Walker, who leads a couple of different AICPA committees I'm on and has been helping me with this initiative, she will be talking with me about it in her Reimagining Your Tax Practice series. I put a really long link here, but if you just Google Reimagine Your Tax Practice series, AICPA, it's the November 20th, or someone on my team might be able to find or grab the link for you and pop it in the chat because I cannot multitask like that. And so there will be this full Excel workbook that I'm gifting to all the members of the AICPA. Now, here's the good news. Whether you're a CPA or not, this methodology is fire, y'all. And so I have an expanded version of the workbook that I'm giving the AICPA that includes a lot more that you can go download right now. Do you want it? What do you think? Whether you use TaxPlanIQ or not, what do you think? Reactions? Awesome. Okay. So here's the link. It is taxplaniq.com/ROI-method. Awesome, 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 awesome. Go grab it right now. And I'm going to walk you through it. And I should have checked what time my session's over because I feel like I'm just could talk all day about this. And
Jackie,
I know.
you got 20 minutes. You got plenty of time.
Okay, good, good, good. Okay. All right. So let's dive in. Let me switch over to my workbook. Give me one sec. And then if there are any really pressing questions, team, just let me know and I can answer that now before I dive into the workbook. But otherwise, should be good to go here. Now, as you saw earlier, or if you're a current user of TaxPlanIQ, this tool is baked into TaxPlanIQ. There's a little light bulb icon that you can use to suggest your pricing. We're making that even easier and more prominent in the next couple of months because of the spectacularity of this huge release and the support that we're getting from our governing orgs. So that'll be good. All right, let's share this. Okay, so this is my expanded version of the workbook. I try so hard to keep this simple, y'all, but I also wanted to give you tremendous value. And so I decided to leave two factors in it. One is a proposal for a one-time implementation fee that you can charge for tax planning that's value priced. And the other is an ongoing monthly package. And I actually list out all the services that we provided at Meyer Tax. You can check off what you want to provide in your packages, hand it off to a graphic designer, and run with it at your firm. So what we did was we charged a one-time implementation fee to the client that averaged maybe 20, 30K. Towards the end, we kept going higher and higher. And so we really got to that 40K, and then like 50K was towards the end before I sold. And then we would charge their first month of their ongoing package fee as well. That's what would be on their first invoice that's ACH'd. So we would present this proposal just like you see it in TaxPlanIQ, right? Now in TaxPlanIQ though, it's combined. So it's all one report where you can show the one-time fee and then ongoing fees. I have it separated here because some people might just want to charge a one-time fee or they might just want to charge a packaged fee. So that's what these different tabs are between the two. All right, so going back to my cover page, in order to get started, we just click the button here, and then these links will take you through each tab of the process. So let's click Get Started. Now, we talked about the ethicality of this. I also linked over to a Forbes article when someone asked, can we talk about the morality? The Forbes article dives a lot more into why I strongly believe and advocate that this method of pricing is the most ethical, more than hourly, more than any other pricing method that I've ever seen, because it's aligning results for the client. You're never guaranteeing the tax savings, but you're going to do your darndest to do the best work that you can. And you're going to work with the client and fix things and make things right if you're not able to bring that value to the table. All right. So I think someone asked that in the chat, and we can always talk through specific situations. We had maybe one client that went bankrupt a year, something odd happened and we couldn't fulfill their plan. And obviously, if I had charged them 40K and then you turn around and you can't implement because of some big life event, you're going to do the right thing for the client. You're going to do that no matter how you charge, right? And so there's always ways that you can adjust. You can lower their package, up their package. You just figure it out as you go and just put in your engagement letter how you do that kind of work, right? What are you going to do if those kind of things happen? You have to be transparent up front so that people aren't confused and colluded on the back end. So I also actually designed this workbook to expand it to any advisory service instead of just tax advisory. So if you offer outsourced CFO services, or maybe you just are really good at reducing people's operating expenses or really good at increasing annual revenue, you can pop that in here as part of your financial gains that you're finding for the client. The financial gains is like the parent name of the different types. So CFO services, tax advisory services, right? Or other types of advisory services. I'll show y'all a little bit more. We'll do a sample together here. So about how to calculate the financial gains. If the client's a startup, I just recommend how you could put them on a flat fee package. And then once they're ready, once you can find financial gains or they've already gotten to the point where they need tax savings, that's when you would upsell them or convert them into a tax planning package like this. How do I present this proposal? It's actually a lot easier than people think. And we do a ton of training on this with TaxPlanIQ users, specifically in the growth plan. But you simply show them the proposal and you say, hey, I estimate that I can save you about 75K a year. Your investment in us would be 15K. Your ROI would be, what, 600%? I don't know what that is on the top of my head. How does that sound to you, client? They love it. Why would someone not do that, right? If they don't have the money, then they definitely aren't going to have that money to pay the IRS. And everyone's happier for it. Now, notice I didn't deep dive into any strategy ideas. In fact, when I present this proposal, I just have totals here. Or in TaxPlanIQ, we have categories. You can list by strategy, but that's only if they've already paid you, y'all. Please do not give away the strategy ideas if no one has engaged you or paid you for the work. And the biggest question that they will press you on is, what are the strategies? What are you going to do for me? I heard about a cost tag. Tell me if that applies. I heard about renting my home. What's a fair market value for my home? They will just deep dive into the weeds and try to just milk you for everything they can, right? And you're going to answer, that's what the implementation fee is for, or that's what the first month fee is for. We will meet, we will do a thorough onboarding session. You will decide which of these strategies you're going to do, and we will go from there to implement. That is not a discussion for today. You need to be engaged as my client first. I cannot 100% guarantee that any of this tax savings, and I don't know if these strategies 100% apply to you. You do want to be 90, 95% accurate, and you tend to be able to do that pretty quickly, especially with TaxPlanIQ's wrap feature where it uploads the 1040. I just did the one that I'm going to show you today, my example in the workbook. It suggests 20 strategies for you in TaxPlanIQ, and it now actually suggests them in order of the biggest potential impact of savings to the lowest. And so if you don't care about that $1,000 savings, if you found potentially like a $200,000 savings, you can start at the top and just pick what you want for that first phase of planning and go from there. All right, let me see what other Q&A I have here that I wanted to make sure and discuss with you. I think I'll let you kind of read through the rest of this on your own. Let's move on and do our example. And let me check the chat real fast, make sure everyone is good to go. The 1040 is uploaded as a PDF in TaxPlanIQ. And for anyone that's saying that they pitch something like this and the client says no, I would encourage you to just keep moving forward with those clients that are going to support you more. There's earlier, someone made a comment that they couldn't afford our software because they weren't making enough revenue yet. You really have to have a mindset shift. And this was so hard for me too. I remember the first large investment I made in myself with coaching when I hired Chuck Bauer, who's retired this year, and our program got retired. And it was like 7, 8 grand. And it was the biggest expense I'd ever had. I went to my husband and I was like, I'm not sure about this. I have no idea what's going to happen. There's this certain aspect of trust that you have to go into. But like at the end of the day, you're investing in you. That's why people are going to pay this price tag. And so you might need to invest first, and then you'll start getting the value back. The return on investment will start coming back to you very, very quickly if you join us and get in our community, get our support, get our accountability. All right, so you pop in your client's name here. You say what kind of service you're quoting. In this example, I'm going to do just tax advisory. So I'm going to skip this kind of general business advisory section. This is what I mentioned earlier. And I tell you things to collect. So last file return, just like when you upload the 1040 in TaxPlanIQ, it's going to automatically pull total tax from your client's 1040, taxable income. Here's my example right here. So we have 187,502 of total tax and 925,899 of taxable income. That's going to give you the effective tax rate, which is a conservative rate to use to calculate your tax savings on deductions. The marginal rate, which for these people is probably 37% or something like that. I don't know. TaxPlanIQ would tell me that. But that's going to be a little bit more aggressive. But if they're way up in the 37% rate, then you could use the marginal rate and probably be pretty spot on as well. And then any state rate involved, you can manually add that here and their cap gains rate. So in this case, we have a 32% effective tax rate. This is a client that moved from Texas to California. So their prior year return doesn't have state information, but they will be subject to California taxes of 11% on top of their federal tax rate for 2024. And so we need to factor that in. And then I talk about other things that I feel are imperative to collect before giving a client this proposal, whether an existing client or new client. We had this all down to a science of like a one-call close. So if you saw my chat message earlier, we would pre-qualify them via email, just ask them what their taxable income or rate is, ask for their tax return. Honestly, if they didn't give us their tax return, redacted, obviously preferred, I don't care about their socials, that was a red flag for us, or a PETA flag, right? And so there's things that as you get better and better at this and become more valuable and more valuable to your clients, you'll become a lot more selective about who you take on, and you'll realize those kind of red flag issues up front really easy to just say, you know what, I'm not the right fit for that. Cash flow that they have available for tax planning. Some things require cash outlay. A defined benefit plan. It's kind of moving from one pocket to another. That's a little more restrictive, right? But it's still a cash outlay. So can they afford to put $300,000 a year into a retirement plan? I just asked what total cash outflow they have available that they'd be comfortable with year to year. Whether that's 50,000, 100,000, 10,000, then you can back into the things that require that cash outflow and make sure that you're not overstating the savings that they could get. Because the last thing you want is to provide a proposal to a client where they're saving 100K off of that defined benefit plan and they don't believe in retirement plans or they don't have any cash to do it. Yes, that has happened to me. It's happened to all of us, or the ones that weren't warned not to do that, right? So like, just take it from me and don't let that happen to you because it's very embarrassing. And collect these little pieces of information beforehand and you'll feel a lot better about it all. Anyone they support financially, hiring kids, etc. Any business interests, material participation, man, I'll tell you, accountants do not pay any attention to material participation. And by checking that box, asking one question and checking that box can be the difference of thousands of dollars of tax savings per year. And we all know it's an annual election, so it's something you should be asking about every single year. Healthcare coverage, we've got HRAs, we've got HSAs, we've got employer coverage accounts, net worth and real estate. If their net worth is close to our estate tax thresholds, then, and I'm putting them on a package, I tend to know I want to put them on my top elite package because that includes working with their estate attorney, which nobody wants to do estate planning work. And so we tend to focus on this phase one of tax planning first, and then circle back to work on their estate plan a little bit later. There's all these phases that you can go through with a client and make sure that they're really comfortable. And then charitable goals. You can be a huge component to someone's charitable giving, which is such an impactful thing. All right, so what are we going to do with this client? Well, if I glance at their 1040, I see that they had capital gains of 750K. So I compile a quick little list of things that I'm going to email the client or send the questionnaire through TaxPlanIQ for. And I say, hey, what was this? Are you expecting it this year? Well, that was 50% of an installment sale of a C Corp. There is one strategy that is so easy to do that most people don't even know about that can save people millions of dollars in taxes. What is it? Pop it in the chat. What do you think it is? Who knows the answer? Who knows the answer? Awesome. Okay, yeah, sometimes I confuse it with the home sale exclusion too, but it is section 1202. Rachel, my superstar. All right, love it. So section 1202 allows up to $10 million exclusion of capital gain on the sale of a qualified small business stock transaction. So I just figured out by looking at this tiny company that he said he sold, I know it's QSBS. I asked a couple more questions around what year it was acquired and sold. It needs to be 5 years, etc. All those parameters are in TaxPlanIQ in my strategy library. I just realized that they accidentally reported this on this return, their prior accountant did, and they shouldn't have reported any of that gain. So I've got an amendment here. And then in 2024, I've got that 750K of cap gains that I'm going to save them. Oh, y'all might have cheated. The answer here. No, Rachel would never cheat. Okay. So I didn't even deal with 2023 because it's not super easy to do in a workbook. TaxPlanIQ, you could have shown the 2023 amendment, charged a one-time fee for that, then shown 2024 forward and charge your ongoing fees or a one-time fee for that. We'd use our cap gains rate plus the state rate for 2024 that they would be subject to in California. That is a one-time tax savings of $232.5K, or double that if you include 2023, right? But this client, I didn't need to show a ton of stuff because there were some heavy hitters here. Okay, next thing. They have a business. Their business netted 109K. Well, they have a tremendous amount of cash flow because they just got 750K off their C Corp sale, and now they're getting another 750K this year. Should we turn around and maybe contribute that to some kind of retirement plan? Now they already have the basics. They have a 401K, that kind of stuff. So what would be our next strategy that we would suggest that we've talked a lot about today? Yeah, well, a Roth, you could definitely fund a Roth on the back end. I'd probably pay the kids, fund the Roth there for sure. Okay, Josette, you got it. Jeffrey, you got it. Cash balance plan. So let's say the client says, I have 100K per year that I can put into this cash balance plan. Jennifer Baker says, oh, you know what? I can actually triple that. We can go ahead and pre-fund the next 3 years. Right? So that would be 300 and something, but no, I'm not going to do that. I'll go conservative. So we'll just say that they're going to just zero out their taxable income on that Schedule C or S Corp or whatever it was, with contributing 109K to their defined benefit plan each year. And that's going to be 35K of savings, and it recurs annually. So I check that off because there's first year savings and then there's ongoing savings in ROI. And then the last strategy that was a big hitter for this client is a really actually very easy to diagnose and figure out as well. Check this out. Other taxes of 27,261. What do you think that was? Well, it is net employment income tax, NIIT. And guess what? When you're selling something that is a non-passive interest and pass through, not C Corp, obviously. So let's say they sold an S Corp or another LLC or something like that, and they way over reported the net investment income tax because they were an active participant in that. I actually messed this up. When the NIIT came out, I'll be the first to admit, I messed stuff up too, right? I filed my client's return wrong. He was an active participant and he was CEO of a huge company that was filing as an S Corp. I'm not sure why they filed an S Corp. That was kind of weird, as like whether they were only publicly traded or whatnot. But I reported it that he was subject to NIIT. He ended up owing like 300 grand in taxes. And then a couple months later, do y'all remember how with TCJA, like all this, they kept coming out with new regulations and expanded regs. And you're like, wait a minute. What's this line in the regs that says if they're a non-passive participant in this pass-through activity that's sold, they are not subject to net investment income tax? Well, that's a huge deal when you're selling stuff for millions of dollars. So in this case, we've identified 20,000 of that 27, 28K, whatever it was. And this happens to be something that they're going to continue selling, year to year, whatever it tends to be. And they'll get that 100% kind of, it's the net investment income tax that I'm stating here. It's not the, like a deduction, right? So it's 100%. And so that's 20,000 of savings there. All right, everyone doing okay? So we've now figured out our financial gains. What's our next step? Well, we determine what kind of ROI we want to bring to the table for the client. We determine any minimum or maximum fees that we want to provide. And you can put all of that into your calculation here. So instead of getting into the weeds of how I do the weighted average, just know that it's all about what ROI you want to bring to the table. If you want 100% ROI, that happens to be about a 0.5 weighted average. If you want 200% ROI, it's 0.33. If you want 300% ROI, it's 0.25, okay? And so we'll use these for our examples here, or you could change this. You might say, well, I want to bring a much bigger ROI to the table, or I don't think I'd charge 72K for this. So let's take our low down even lower. This is more in line with what I would have probably charged this client for these particular strategies. And I assess my curb, the complexity, the urgency, the risk, and the intangible benefits. The intangible benefits could be unlimited email assistance. It could be 4 meetings over the next month. It could be a concierge level of service, you picking up their documents. There's all kinds of intangible things or competitive advantages you bring to the table that you can show the client through the intangible benefits. And so I set those parameters as low. It calculates that year one savings, and my one-time implementation fee is suggested at 31,612. That's an ROI of 809%. And then if I want to also charge an ongoing package fee, maybe I'll do their tax prep and ongoing tax planning for the strategies in the scope of this offer. If we did new strategies, we would add those. It would be out of scope, right? Now, I'm not talking about like they buy a car and you 179 it later on. You've already charged them a good amount of money. I just roll that stuff in. That's what kind of adds to that ROI later. But bigger stuff like selling a company, those tend to be more out of scope items that you'll want to quote separately for. And so ongoing annual year-to-year compliance work, I've said, okay, I think complexity is going to be about medium, urgency is low, risk is, medium or so, and intangible benefits are high because I offer a concierge level of service. And so this is suggesting that you price it at $14.54 a month. And there's 2 months left in our year. And so that will all go into your ROI proposal. How much time do I have left? Uh-oh, I'm running over.
You are over, but I did ask our panelists if they can go a little bit longer on the panel. So you think you can wrap it up within a couple minutes? I know there's a couple tabs.
Yes.
All right.
Okay, 1 more minute. Sorry, I get super excited about this. So what I've included in this expanded edition of the workbook is your package setup. If you do want to offer 3 package tier levels, I show you exactly what we offered at Meyer Tax. You can adjust this to your liking, and then that will all flow over to the final proposal for the monthly ongoing package, show the client that ROI. And I kind of filled in the package info here, but you're going to have to do some manual stuff here because I couldn't remember how to do some of those macros. For the one-time fee, you would simply quote them that 287K of initial year savings and our immediate ROI. And then, of course, you have that ongoing as well on the other proposal. And that is the ROI method of value pricing. So what do y'all think? Did I explain it well? Are you feeling confident about it? I'm going to stop sharing. Yes, good. Thumbs up. Awesome.
There's a lot of questions that came through that I've got on the question sheet that we're going to get to here as we get into the panel. So.
Okay, very cool. So go to TaxPlanIQ.com/ROI-method. You can download that exact workbook right now and take it, run with it. I've got one of our users that's about to pitch their first $100,000 plan using this workbook, and I cannot wait to see the acceptance come through on that because the client is going to be so excited and really, really receptive to it. So thank y'all so much.
Awesome.